When you look at, I guess, the overall economic picture, some of the improvements that have been made in our economy here in the U.S. as well as globally, and you go back 40, 50 years ago when you were starting, what are the improvements that you've seen?
Well, clearly, the events of last year, to the extent that they're indicative, showed that we've learned how to fight recessions, And, we used to have recessions that really kind of got out of control and went on for a long time. In the global financial crisis of '08, post the Lehman bankruptcy, the government figured out some things, ranging from quantitative easing to guaranteeing commercial paper, et cetera. And those things worked. They took them some months to do, but they worked. They applied those lessons last year in the pandemic in days or weeks, and they worked enormously. So that's an example. And of course, on the other hand, one of the great trends of the last 50 years is that most markets have become more efficient. Mm-hmm. Buffett used to talk about buying dollars for 50 cents routinely. It's hard to do when there are a lot of other intelligent people looking for the same 50-cent dollars.
Right.
And they all have good eyesight, and they're all highly motivated, which is where we are today. So it's gotten harder to beat most markets.
Is that efficiency? Is that good for the market overall? I know for investors that's not always good.
Well, in theory, efficiency is good for the market because it helps companies raise capital at a fair cost, and it helps people invest at a fair return. But of course, people in my position are not looking for a fair return. We're looking for a return that's more than fair. What the academic would call an excess return. That's why we exist. If you're willing to take an average deal, you don't need us.
No.
Investing, it's really easy to be average, and it's quite hard to be above average, and it's gotten harder. Right. And the measure of superiority has shrunk over time. That's efficiency.
Right, and where you benefited and where a lot of investors of your generation benefited was there seemed to be a little bit more randomness to the market. There seemed to be a little bit more asymmetry in the market that can be exploited. If we're at a stage now where everyone knows everything.
Well, I mean, when the markets become more efficient, it becomes harder to outperform. Mm-hmm. And that's where we are. I look at high yield bonds. I was in with Mike at the beginning of the high yield bond world. I met Michael in November of 1978. The high yield bond world started in 77 or 78. And I could put together portfolios that would have higher returns with lower risk. Mm-hmm. Then the market got a little more efficient. And then you had, if you wanted, it was a great achievement to have a portfolio with a higher return with the same risk. Mm-hmm. When the market becomes more efficient, portfolios that have higher returns generally have higher risks. So the world becomes less attractive from the point of view of a bargain hunter. Mm-hmm. Today, or in recent days, I would say that the best inefficiencies have come cyclically, not secularly, but cyclically. And there have been 3, 4, 5, 6 occasions in the last 25 years when at least the potential was there to add value by timing the market right, and knowing when we were at extremes.